Welcome back, everyone, to another deep dive. This time, we're going exploring the world of pharmaceutical companies with high-yield dividends.
Sounds intriguing.
It is, right?
Mm-hmm.
So we've got a list of 3 companies to look at today.
Okay.
AbbVie, Gilead Sciences, and Pfizer.
Mm-hmm.
All of them have been recommended by Motley Fool contributors as potential picks for November.
Interesting.
You know, this is for anyone really thinking about maybe dipping their toes in the investment pool, or even if you're just curious about how the pharmaceutical world works, or if you like seeing how companies handle big challenges.
Right, yeah.
We're going to cover some pretty interesting stuff today.
Oh, like what?
Well, we're going to be talking about a drug that has almost half of the market share.
Wow.
A company that boosted its dividend by, get this, 310%.
Seriously?
Yeah, and we're going to look at a stock that's trading way, way lower than average right now.
Sounds promising. Yeah. But before we jump into the specifics of each company, maybe we should take a step back and talk about what high-yield dividend stocks actually means.
Good point. So for our listeners who aren't familiar with the term,
Yeah.
what are we talking about here?
Well, a high dividend yield basically means that a company is paying out a larger percentage of its profits to its shareholders as dividends. And that can sound really attractive, obviously.
It's free money.
But here's the thing. Not all high yields are created equal.
Oh, okay. How can you tell if a high yield is, a good sign or more of a warning?
Well, that's where careful analysis comes in. You see, a high yield, it could mean that a company is a real cash cow, just consistently generating strong profits and happily sharing them with investors.
Right.
But on the flip side, it could also mean that the stock price has dropped, and that's what pushed the yield higher.
So that's not necessarily a good thing.
Not necessarily, no. It could be a buying opportunity, but it could also be a sign of trouble ahead. So you really have to look at the whole picture. Got it. So let's dive into our first company then.
Okay.
AbbVie. You mentioned earlier a pretty big dividend increase. I mean, 310% since 2013.
It's pretty impressive, yeah.
That's incredible. Plus, they just announced another boost, like a 5.8% boost.
Yeah.
So their yield is now at 3.2%. So they've got a solid track record there.
They do, but there's a twist. AbbVie is actually facing a pretty big challenge right now.
Oh.
Their top-selling drug, Humira,
Okay.
recently lost its patent protection.
Oh.
Which means now other companies can make generic versions.
I see.
And that's already hitting AbbVie's sales pretty hard.
Yeah, what are we talking, what's the percentage?
Well, their sales are down 34% this year.
Wow, that's a huge hit.
It is.
So how are they dealing with that?
Well, I'll tell you, instead of panicking, AbbVie has been pretty strategic. They've been acquiring other companies to diversify their portfolio.
Yeah. And what's really interesting is that even with that drop in Humira sales, they've still managed to grow their overall sales.
Really?
Yeah. It shows they're adaptable and that they planned for the future.
So it sounds like diversification is key here.
Oh, absolutely.
Don't put all your eggs in one basket.
Exactly. And AbbVie's story really shows how that can protect a company even when they face, a big setback. Now, another thing to look at with AbbVie is their price-to-earnings ratio.
Okay, now, for those of us who are new to this,
Sure.
what does that ratio tell us?
So it's often called the PE ratio.
Okay.
And it's a way to compare a company's stock price to its earnings.
Okay.
So a lower PE ratio can sometimes mean a stock is undervalued by the market.
Interesting.
Now, AbbVie's PE is 17 right now.
Okay.
That's considered pretty low compared to the average.
And that makes it attractive to investors.
It can. Yeah. It can make it attractive to dividend investors and those who are looking for growth potential.
Got it. Okay, so let's move on to our next company, Gilead Sciences. I know they're also known for having consistent dividend increases.
They are, yeah.
Up 22.2% since 2019.
It's true. Now, they've also had their own set of challenges, like regulatory hurdles and the impact of the pandemic, of course.
Yeah.
But their commitment to increasing their dividend has been pretty remarkable.
Yeah, it's impressive.
Yeah. And a big reason for that is the success of their HIV drug, Biktarvy.
Okay.
It holds a 49% market share in the U.S.
49%.
Yeah, almost half the market.
Wow. I mean, that's dominance. No wonder they can keep upping those dividends.
Exactly. That consistent revenue stream from a market-leading drug gives them a lot of stability.
Yeah.
even when facing, those external pressures.
Mm-hmm.
But Gilead's not resting on their laurels. They're actively pushing into the oncology field now.
Oh, wow. That's interesting.
Yeah, over half of their clinical programs are now focused on developing cancer treatments.
So they're not just, a one-trick pony with Biktarvy.
Right.
They're looking for new avenues for growth.
Exactly. It's a key sign of a company with long-term vision,
Yeah.
which is what you want as an investor.
Absolutely. All right, so last but certainly not least, we have Pfizer. They've got that impressive 6.1% dividend yield.
It's eye-catching, that's for sure.
Yeah, hard to ignore that.
And Pfizer's been pretty clear about their priorities. They want to maintain and grow that dividend.
Smart.
But there's more to the story than just the yield. Pfizer's actually trading at a surprisingly low PE ratio right now.
Okay, remind me again, what does that PE ratio mean, and why is a lower one potentially good?
Right, so remember, the PE ratio compares a company's stock price to its earnings.
Okay.
And a lower PE ratio might suggest that the stock is undervalued. Now, Pfizer does face some potential headwinds, like patent expirations on some key drugs coming up. However, they have a really robust pipeline with 108 programs.
108.
They're various stages of development.
Wow, that's a massive R&D effort.
It is. They've got a lot of potential blockbusters in the works, which is why some investors think that Pfizer's current low price might actually be a buying opportunity.
So it's not just about the dividend they're paying now, but also their potential for future growth, right?
Exactly. And that's how we should be looking at all these companies. High yields are great, but they're just one piece of the puzzle.
Yeah, I'm starting to see that. Okay, so we've got these three companies,
Yeah.
all with high yields, but they've each got their own story.
That's what's so fascinating about this. We've got AbbVie. They're skillfully navigating the whole patent cliff situation.
Right.
Then you've got Gilead. They're dominating the HIV market while strategically, branching out into oncology.
Yeah.
And then you've got Pfizer with this massive pipeline of potential future blockbusters. It really shows how companies in the same industry can take different paths and still find success.
That's a great point.
Okay.
So, of all the things we've learned about each company so far, what do you think, what stands out the most to you? What are your key takeaways?
Well, it's early, but I think we're seeing a theme of resilience emerge. All these companies are facing challenges, patent expirations, market shifts, regulatory hurdles, all of it. But they're finding ways to adapt, innovate, and continue generating value for their shareholders.
Yeah, I like that. It sounds like they're all fighters in their own way.
They are.
AbbVie's diversifying, Gilead's branching out into new areas,
Right.
Pfizer's investing heavily in R&D. They're all facing these hurdles head on. It's pretty inspiring, actually.
I agree. I think it's a good reminder that even in a complex industry like pharmaceuticals where things are always changing,
Right.
companies with the right strategy, and a little bit of grit can not only survive, but they can really thrive.
Yeah, I like that.
It's more than just surviving, though, right?
Right.
It's about making smart decisions that set them up for that success long term.
Right, exactly. So we've seen how these companies are, adapting and innovating. But I guess I'm curious, what about the bigger picture?
Okay.
What trends are shaping the entire pharmaceutical landscape these days?
That's a great question. The industry is constantly changing, constantly evolving. For example, we're seeing a real shift towards personalized medicine. Treatments that are tailored to a person's specific genes.
Wow.
Gene therapies are becoming more and more common, too.
Yeah, I've heard about those, yeah.
And they have the potential to cure diseases that we basically thought were incurable before. It's pretty remarkable.
That's incredible.
And there's this growing focus on preventative care, too.
Makes sense.
It's not just about treating people when they're sick, but keeping them healthy in the first place.
Yeah, that makes a lot of sense. So it sounds like the future of healthcare is going to be pretty different from what we see today.
Oh, absolutely. And for investors, that means that understanding these trends it's critical.
Oh.
You need to be able to identify those companies that are on the cutting edge, the ones that are really shaping the future of healthcare.
So it's not just about analyzing a company's current performance, but also their potential, right? Their potential to capitalize on those emerging opportunities.
Yeah, get at. It's about finding the companies that aren't just keeping up, but the ones that are leading the charge, the innovators, the game changers.
Okay, I like that. So we've talked about, resilience, innovation, and all these trends shaping the industry.
Hmm.
But let's get practical for a second. What advice would you give to someone who's thinking about investing in one or more of these high-yield dividend stocks?
Well, I'd say don't let those high yields be the only thing that you're basing your decision on. It's easy to get caught up in the excitement of a big payout, but it's crucial to do your research, really do your due diligence.
So what does due diligence involve in this context?
It means you really need to dig deeper, go beyond those headlines, and understand the company's financials, their business model, how strong their management team is, are they transparent in their reporting, all that good stuff.
So it's about getting a feel for the company's, overall health and stability.
Exactly. You're looking for consistent profitability, manageable debt levels, and a clear plan for future growth. And don't be afraid to compare. How does this company stack up against its competitors? Are they ahead of the curve or are they falling behind?
It sounds like there's a lot of research involved.
There is, but it's worth it. Remember, investing is a marathon, not a sprint.
Right.
It's about finding companies that you believe in for the long haul, the ones that are building a sustainable future, not just chasing those short-term profits.
And of course, every investment has some level of risk.
Oh, absolutely. There are no guarantees when it comes to the stock market. That's why it's so important to think about your own risk tolerance. How much volatility are you comfortable with? What are your goals? And how does this specific investment fit into your overall plan?
So it's about finding the right balance between potential reward and an acceptable risk.
Exactly. And never forget the power of diversification. You've heard it before. Don't put all your eggs in one basket. Spread your investments across different companies, different industries, different asset classes. It helps create a more resilient portfolio.
Right. It acts as a sort of cushion in case there's a downturn in any one area.
Exactly. Now, I think it's important to step back for a minute and remember that these three companies we've been discussing, they're really just a starting point.
Of course.
There's so many other companies out there. Each one has its own story to tell, its own potential, and its own risks, of course.
Right. And like we've been saying, it's not enough to just look at the numbers, You really got to understand the whole picture.
That's it. Think about the industry trends, the regulations, the competition. You could even consider the ethical implications of a company's actions. How do they align with your own personal values?
That's a really good point. So it's not just about, making money. It's about making informed and responsible decisions.
Exactly. It's about supporting companies you actually believe in, the ones that are making a positive impact on the world while also generating value for their shareholders. It's about being an active participant, not just a passive observer.
That's a great way to put it. So I think we've covered a lot of ground today, from the specific strategies of these three companies to the broader principles of, investing as a whole. I hope our listeners are starting to see how fascinating and how potentially rewarding this journey can be.
It really is.
Yeah.
And remember, this is just the beginning. There's always more to learn, more to discover, more to understand about this ever-changing world of investing.
So to our listeners, I encourage you to keep digging, to keep asking questions, and to never stop learning. As we're wrapping up here, something just occurred to me. We spent all this time talking about pharmaceuticals.
Yeah.
What about other industries?
Oh, interesting. You're thinking maybe there are other sectors out there with companies that offer those same opportunities.
Exactly. High-yield dividends, long-term growth potential. We found some really interesting stuff in the pharmaceutical world, resilience, innovation, finding value where you might not expect it. What if those principles apply in other areas, too?
That's a great point. It really does make you think outside the box, doesn't it?
Yeah.
We could use this same approach, the same lens, to look at other sectors and see what we find. Maybe uncover some hidden gems.
Right. Imagine finding a company in, maybe renewable energy or even tech that's going through a rough patch, but they've got, a solid plan for the future. They're paying a good dividend while you wait for the stock to rebound.
It's like we've got a whole new treasure map to follow.
Yeah.
We've learned how to analyze these pharmaceutical companies, and now we can take those skills and apply them to completely different industries.
Exactly. It's all about seeing those underlying patterns,
Wow.
Financial strength, good management, the ability to adapt to change. Those qualities can lead to success no matter what the field is.
You're absolutely right. That's what makes investing so, so exciting. It's not just about, picking stocks. It's about understanding what makes the world tick, the companies that are driving those changes, and how we can be a part of that growth as investors.
I'm feeling inspired already. So, to all our listeners out there, I hope this deep dive has given you a framework for thinking about high yield dividend stocks, not just in pharmaceuticals, but really in any industry that you're interested in.
Don't forget, though, it's not just about chasing those big yields. Look for companies that are well-managed, financially sound, with a clear vision for the future. Do your research, understand the risks, and make sure your decisions are lining up with your financial goals.
And maybe most importantly, stay curious. There are so many incredible companies out there doing incredible things. Take the time to learn about them, explore different industries, and don't ever stop looking for those opportunities that spark your imagination and of course, your portfolio.
Well said. Happy investing, everyone, and until next time, keep exploring.